So you were a student of the media sector. Explain to us what the motivation is. We put a chart up just a moment ago about how the stock has reacted, and it looks like the shareholders like the idea of some sort of a transaction like this.
Well, I think what's behind this transaction and certain others, including AT&T, Time Warner, is a notion in the 21st century of what constitutes leadership scale in the media business. And you have a landscape in which new entrants with far higher market caps, Facebook, Amazon, Google, even Netflix, having climbed pretty high in market cap to this point, are changing the nature of thinking around what appropriate scale is for leadership. And so Disney looking at these Fox assets, or Fox itself looking at its own business and saying, okay, do I have the necessary scale to be a leadership competitor in the next phase of the media business? And the answer for a lot of these companies is, well, maybe a reconfiguration is necessary. Maybe I need more content scale, maybe I need more distribution scale. What's really interesting underneath this is that as you look at those new companies competing in the media landscape, if you look at how Google's competing, how Amazon's competing, Facebook, Netflix, et cetera, they're competing also at a different level in that they have direct connectivity to the consumer in a way these traditional media companies do not. So if you go back a generation, the best way to compete is to aggregate scale across content, aggregate scale across distribution, and then link those two, as Comcast and NBCUniversal did, so that you have both content scale and distribution scale, and that will create a leadership position in the competitive market. Today, you might need a third layer, which is direct connectivity with the consumer, to really be at scale in this business. Right. And when you look at Disney and you look at Fox, and Disney is perhaps looking at its own capability in the future of directly connecting with the consumer right. through its acquisition of MLBAM or potentially through Hulu, that's really, I think, some of the things that are animating this deal.
And Disney CEO Bob Iger has said, we want to go direct to the consumer. We want to have yes. our own subscription service. To illustrate your point a little bit, let's put up a chart of actually tracing at least directionally Netflix stock versus Disney stock over the last year. And you can see from this chart where they're basically headed in opposite directions. It illustrates a bit why Disney might be thinking, we've got to move into this territory.
I think that chart is very much on the minds of Disney and other players in the media business. The larger theme here is as consumers are deciding how to experience their media in different ways, whether that's directly through over-the-top or perhaps through their personal devices such as phones and pads. That is creating, again, a sea change of thinking among media companies to how they need to compete in that next generation.
Just to go to the chart, because we have it up now, the blue line there at the top for the viewers is the Netflix stock, and the white line is the Disney stock. So you can see the contrast. So let's go to some of your investments and how they illustrate some of the points you're making, particularly sure. like UFC, for example. Talk about UFC, why you've invested in that, how that's going.
Well, we invested in the UFC as a content business and a sport that can actually thrive regardless of the distribution modality that it is in. So if you look at the UFC today, which is operated by Endeavor, who is our partner, and we think one of the best operators, certainly, of this kind of asset in the world, it is able to connect with its audience both through broadcast and through over-the-top. Fight Pass is their own over-the-top vehicle, and through pay-per-view, and it is the largest pay-per-view company in the world today. That is that kind of tripartite capability of connecting with fans, and of course live events as well, allows you to gear the business in the direction that the audience wants to go from a distribution standpoint.
So it's a powerful brand with the people who are fans of UFC, no question about it. But in this new world, is it big enough on its own, or does it have to pair up? Do you ultimately have to pair up with other content providers into a larger service?
Well, as a sport, and it sort of defines the mixed martial arts as a sport, I think it is plenty big enough standalone, because if you're a fan of that sport, that's where you go to see the best matchups and the best cards. If you look at it on a wider basis, we think one of the reasons that Endeavor is the right operator for the assets, and is the the way that asset gets to the audience the best is because they do have connectivity across the landscape. They are one of the biggest, I should say, the biggest purveyor of sports rights across the world. And we think from an international expansion point of view as well as domestic, they're the best player to get you to the audiences that you want to get to.
So Richard, spend a minute or two on something we don't normally think of as a media property, and that's WebMD, which is something else that you own.
Yes.
How do you see that as fitting into what we've just been talking about?
Well, WebMD, as you know, has two major businesses. One is WebMD, as consumers understand it. That's where you go for your health information. The second is called Medscape, and that's where professionals go for their information, somewhat more specific and somewhat more professional. The WebMD on the consumer side is very much like, an over-the-top information service to consumers. So consumers come to this information either directly over the web or through search and find, basically the information that they need to see on, for themselves or their loved ones on what kinds of conditions they may have and treatments they may have and options they may have, et cetera. That is, and just to connect this with the original point, that provides advertisers, for example, pharma companies and advertisers, with an ability to connect directly with their consumer base rather than on a fully targeted basis, rather than blasting out a message on the side of a bus.
So the thing I find fascinating is we don't normally think of WebMD as over the top. We think of ABC or CBS or NBC as that way. If that's right, does that suggest there may be a lot of companies that have content that they want to get to their ultimate consumers with that, who actually are becoming media companies in a sense, and they're going to need to go over the top, as it were?
Right. I think any company that ultimately has consumers in their orbit is thinking about how to directly connect with those consumers. That's why companies have websites. That's why companies have social media presence. And I think e-commerce has taught an awful lot of companies in the product arena, how do we connect directly with these consumers with a message that will really resonate with them. And if you look at the most successful 21st century companies, they are able to create that direct messaging to the consumer by themselves without being mediated through, only mediated through retail channels and other kinds of intermediaries. So I think that is a wide theme, and the fact that we've always got connectivity in our pockets and our homes at all times is creating that new dynamic for companies outside the media business as well as companies inside.
It really is a brave new world in many respects.